Good morning. This is going to be a meeting on this day, February 25th, 2021 of the Metro Adjustment Committee. Our committee members have been Christine Bradley and Tom Curtis, and thrilled to say this morning that we have Dr. Stephanie Bailey rejoin our committee. She had been away from us for some period because of the health department, and I think she's concluded her activities there, and we're just thrilled to have her back to the benefits board and to the investment committee. So welcome, Dr. Bailey.
Thank you. It's good to be back.
Welcome. And some things haven't changed at all, including for me to establish a quorum. And if I could just acknowledge here really that we do have Christine, Tom, and Dr. Bailey with us. We have been talking prior to the call, so I know that we've got that quorum. One of the things that's incumbent on me in this format is to ask for a motion that due to the COVID-19 pandemic, that it's necessary to hold this meeting by electronic means to protect the health and safety of the members of the committee, the consultants, the staff, and the members of the public. Could one of you make a motion?
Yeah, Tom Curtis, so moved.
Christine Bradley, second.
I believe I need to do a roll call vote, and so I'm going to continue to just do them in the order that they're listed for me. So, Christine?
Present, and I agree.
Tom?
Tom Curtis, yes.
Dr. Bailey?
Stephanie Bailey, present and yes.
Provo Chair present, and yes. So that's for our electronic meeting. Let me move next to a review of the minutes. I know those have been on everyone's SharePoint email queue and perhaps some other means you printed them. Could I get a motion to approve the minutes of the last meeting?
Christine Bradley, so moved.
Tom Curtis, second.
So roll call vote, Christine?
Yes.
Tom?
Tom Curtis, yes. Tom Curtis, yes. Yep.
Dr. Bailey, are you a yes?
Having read them, yes.
Thank you for that. I think, Dr. Bailey, even with you being new and not a chance to review the meeting that you didn't attend, I think we still have enough to pass that. So we can let the record reflect that, perhaps an abstention from Dr. Bailey if she's comfortable with that. Great. Okay, so I'm going to move us through our agenda. I know most of our meetings, we get a perfunctory start here as we go through those formalities and then some reports, and then we can get into the meat where we can spend some time and talk with all of our presenters, ask questions and whatnot. So I'll move to the first one on the agenda, which is for Phil Carr to cover our CAFR for this year.
Sure. I believe Caitlin is going to attempt to pass over the sharing screen ability to me so I can actually show you what I am talking about.
Yes, I just did that, so you should be able to share.
All right, so let me figure out how to do that.
Bill, I've heard you've had sharing problems for a long time, and
I know. My selfish nature.
That started at a young age.
Yeah. Well, you guys tell me, can you see a comprehensive annual financial report?
We have a marvelous, thank you for using the Cisco WebEx.
That's the wrong screen. Let me switch it out here.
Phil, did they give you your own sandbox or not?
Say that again. Oh, yeah.
Did you?
All right, is that any better?
Yes.
All right. I think one of the good things about doing this virtually, if I recall, I think last year I handed out a copy that had the pages upside down or backwards or something. So at least I can avoid that by controlling the version that we're looking at.
And
So
Phil, excuse me, Phil, this is Stephanie Bailey. Could you make it as big as you can? I know this
I
might
can
challenge you
try to kind of get it to display a little more.
a little bit larger, especially
Yeah.
when we get to the numbers. Thank you.
Yeah, we'll try to work with it a little bit when we get to the numbers. So yeah, again, I appreciate the opportunity just to kind of share with you guys a little bit about the CAFR and particularly the information surrounding the pension plan and kind of your role in those numbers. So I'm just going to jump to a few different pages, and again, this is familiar to what we did last year. So I'm going to jump to the pension schedules. So this is basically the balance sheet for the pension plans, and this is the sort of the combined pension plans. So again, it's primarily the open plan, but also the few closed plans that we still have. So looking at this, the requirements require that we disclose the different types of investments. So that's all information that we're obtaining from the agents there who manage those investments. So, looking at the total pension plans, our net position was, roughly 3.4 billion for June 30, 2020. Looking at the actual, basically the income statement, again, this is all directed by the accounting standards as to how we have to disclose this or how we report it. But basically, the top part up here is all the investment activity related to the pension plan. So we basically had gross earnings of roughly 160 million. We had expenses of roughly 37 million, so a net of 123 contribution to the plan from investment activity, essentially. The bottom part is, the actual plan itself. So we have contributions coming in primarily from the employer contributions, obviously payments going out. So the actual pension plans themselves, we had a total increase of around 26 million in the net position compared to the prior year. Do you all have any questions about the actual financial statements for the pension plans? All right, let me just keep moving ahead. Find the page I'm going to. So this particular page or particularly section of the CAFR, it's referred to as RSI, and it's required supplementary information. And again, these are all disclosures that are required by the governmental accounting standards. So what this does is basically provides a comparative of this year, and ultimately this will be 10 years of data. We're adding to it. This was disclosure that started a few years ago with some changes in the accounting standards, but it provides sort of a historical perspective. And this actually has each individual plan broken out. So I'm going to page down here to Metro's open plan, which is, again, where the bigger dollars are for Metro. So again, this is kind of a little bit similar to what we or what we looked at last year, but this is the Metro's open plan. So looking at this plan by itself, this top part information is basically what the actuary is calculating for us. So again, the actuary is projecting out what the pension benefit payments needs to be, what we project earnings to be, and basically coming up with a total pension liability. So for June 30, 2020, the total pension liability was this $3.489 billion. The part down here, the plan fiduciary net position, this is the part that Metro manages. So again, this is the pension plan itself. So the way this schedule works, it's saying, okay, this is your total liability. This is what you have in your plan. So again, this is basically the net position for the open plan. So your net liability is $260 billion. So again, total liability, 3.489 billion. You've got in your plan, 3.272 billion. 216 is the pension liability. And then the ratio that everyone talks to is sort of that funded percentage. So this is, again, it's basically looking at what you got compared to what your liability is. And we are 93.79% funded in the open plan. And again, this is comparative. You see each fiscal year, if you kind of go over, this is, the next column is 19 and then 18, and then it actually goes on back further. So you can kind of see the trends here. So you do see that our liability or our funded percentage decreased a bit compared to last year. Again, I think we would all agree that 93.79 is still a very well-funded plan, but you can kind of see where that's happening. Again, like the total pension liability had an increase of yeah, I think that's where the page go. Hold on, I'm not responding at the moment. So the hold on. Having a little trouble maneuvering my page here. So my total pension liability increased to 111 million. Whereas we the plan position itself improved, it improved only 17 million. So you kind of see, even though we're improving in the net position of the plan, our total pension liability is growing by a larger number. So, the net pension liability increased compared to last year. So accordingly, the percentage, the funded percentage is a little bit lower than it was last year.
Phil, this is Tom Curtis. That's these numbers are as of June 30, correct?
Yes, they are June 30, 2000.
So, I mean, it is what it is, and as were all the others are June 30, but at least, the last 6-7 months, the market's done pretty well since then. So I think, we're probably at a higher funded ratio now, but anyway, I just think it's worth thinking about that we caught it pretty much at a low point, but which is a little comforting to me. So
yeah, well, it's comforting to me as a future retiree as well. So yeah, it's again, it's a point in time, and depending on what happened or what the market looked like at that point in time, certainly impacts the net position of the pension plans.
right. Okay. Thank you.
And Phil, this is Stephanie Bailey's. So within this last 6 months or 9 months, I know you do some spot checking. I mean, you just don't wait every June to do this. So what are you seeing? Because I like to see us to stop the trending down of the percentage. We went, looks like 97 point something. So in that from June 30th to now, a spot check would show us what?
I think a spot check would probably show us, fairly healthy earnings for the months to date for the fiscal year. But, obviously there's still additional months that are unknown. So, yeah, I think, to Tom's point, probably if we looked at it today, the plan net position would be a bit higher than it was at June 30, 2020. Honestly, I haven't really gone out to confirm that, so I'm guessing a little bit. But again, I think just sort of based on market, that's what I would expect.
Phil, can I jump in for a second?
Sure.
So, great question. And of course, keep in mind, this is the 93.79% is not the actuarial number. The actuarial is a little bit different number that's more smooth. But as far as the question, we're almost at 4 billion today. So as of last night, we're at 3.99. So we've had a pretty big run up. And, if things do hold, the pension plan will be over 100% on a market value basis. But, actuarial number smooths that out over a 5-year period. So I think we should be in good shape, though.
Thank you, Fadi. And it's good to see your voice, hear your voice. Hello.
Hello, good to see you back.
So I'm just going to point out one more page, and again, it's I guess, and we're talking about the performance for the last fiscal year. I can page down to this one quicker than I can find it through the bookmark. Again, another one of the required disclosures is this schedule of investment return, and again, this is dictated by the accounting standards, and it dictates the way we calculate it. So it's a fairly simplistic calculation of that annual money weighted rate of return, and then it's net of the investment expenses. So again, sort of talking about performance, you can see for 2020, our return was down, which again I think is obviously consistent with what the market was doing. So again, it's a point in time calculation, or in this case, it's a year calculation, which, to Patty's point, I think we would expect a higher return in 2021 if things continue as we're seeing them now.
Hey, Phil, this is Christine.
Uh-huh.
So could you scroll down and let me see what it was in 2008, 2009?
This is actually just 10 years, so 2000.
Oh, I'm sorry. Okay.
But I can get you that information. We basically drop off a year each time, so it's always
Right.
just 10
Okay.
years.
It was a big negative number.
I remember, Fadi, and I just, no. Yeah.
So those are really the pages I intended to point out. The capper is actually available on Metro's website. If you kind of drill down through finance, all of our reports are there. If anybody does want a hard copy, I can certainly get that to you. But again, I appreciate the chance to join your meeting again, and appreciate the work you guys do to help out our pension plan. And if there's anything I can do or any information you need, just let me know.
Hey, Phil, thank you. This is Tom Curtis. I would like a hard copy. I'm one of those guys that actually still has mine from last year. But if I can come by the treasurer's office or whatever is the easiest things to do.
Yeah, I'll reach out to you and we'll coordinate how to get it to you.
That'd be great. Thank you. Thanks so much.
Sure.
Good report.
Phil, before you go, I just wanted to recognize you. Here again, I think most of you know Phil, but for those who don't, one of the hardest working folks we'll find in the Metro government. He has a big season of preparing reports. It starts late in the summer and really goes through now. And it's not just this big annual report, but also the single audit report and a number of other things that support it. We've added quite a lot of cash flow measurement and management in the last year or so that he's really moved along and helped with. And so, Phil, from the bottom of my heart, thank you for everything you do. And it's much appreciated, much recognized.
Well, I appreciate it. Thank you. It's been a challenging year for all of us, and certainly your support and everyone's support really helped us kind of get through it and get everything done.
Always a comfort to me when I'm on a teleconference and they say, Phil's looking at that. It's like,
That's great.
all right.
Thanks
Phil,
again, Phil.
Thank you.
Okay.
Good. So I'll move to our next item here. It's our fourth quarter 2020 pension performance. And I think by now, all of you have met and had some interaction with Michelle Bosch, our treasurer. And for those who haven't, for some reason, she started with us back in September and had the enormous shoes of one Tom Edelman to fill. And she is doing a great job of that. Tom himself, I think, has been very helpful getting her kicked off in a good direction while he himself has moved to something new. He's running our O&B group, which there's not a place really that there is more pressure coming up here in the spring to perform and perform well on the heels of all that has been 2020 and the early part of 2021 here. And so, Michelle, I'll let you just take it from here and got us this next topic.
Hey, Kevin, she had to jump off until about 10:15. So she said to she texted me and said to let Keith go ahead with performance, and she'll speak after he's finished when she jumps back on.
Like I said, Keith is great at this.
Sorry, I didn't want to interrupt you. It was such a great spiel.
Great. Please tell Michelle later that we were thinking of her, but we're glad to have Keith too. So Keith, take it away.
All right, Caitlin, you want to let me drive?
Yes. Phil, can you right-click Keith's name and make him the presenter? That way he can share his performance report. Perfect. Thank you.
All right, let me, since I have 1,000 files open, give me 1 second. Okay, so hopefully everybody can see this. Yeah, very good. So as we've done, I know we're lagging a little bit, so I'll try to pick up some time and get into the recommendations. But again, we just saw a hint of the performance there through June 30. You'll see, when we go through this report for the trailing calendar year of 2020, returns are very strong, particularly in the fourth quarter. Just really high level market dashboard here, kind of really starting on the right-hand side. Early November, got news of 2 vaccines. So that really put a floor into the market outside of what central banks have been doing around the world there. And you can see double-digit returns, not only in the US, so the S&P up 12, Europe and Australia, kind of UK 16, and in emerging markets, think of China, South Korea, Greater Asia, up 20%. That trend has kind of continued into the first quarter as well. A little bit of hiccups the last few days, but near all-time highs for the markets there. On a macro level, dollar's been under pressure a little bit. We're printing trillions of dollars in stimulus. On the fiscal side, on the monetary side, the Fed has kept rates near zero, so you've seen some pressure there. That's actually positive for your non-US investments. So the weaker the dollar translates to higher returns when those dollars come back. On the credit side, so your investment grade just shy of 1%. And again, these are quarterly returns, so you can see very strong returns. Investment grade just shy of 1%, high yield. So typically trades with equities there. So below investment grade type stuff, 6.5. And then really on the real assets front, oil. So you'll get a lot of this in your real assets portfolio. Gold, sort of a safe haven store of wealth. Just shy of 1. And then real estate REITs, kind of contrary to, what folks are thinking. Office and, retail's under pressure, but other areas are holding up. You have 0% interest rates. They produce a nice monthly income flow there. So there is some support for that sector there. So that is the returns for the quarter on a market level there. I highlighted just a few of the broader indexes. So if you go left to right, on the left-hand side are the major benchmarks. And, as you move to the right, you can see year-to-date returns. So S&P up 18, the Russell 2 was up 20% for the year, and you'll see in the fourth quarter is up 30 something. So again, we got that vaccine news, kind of light at the end of the tunnel, particularly for, smaller U.S. centric type companies. Strong returns there.
Keith, can you make that a little bigger?
Yeah.
I was just about to say
Thank you.
the same thing, because we just give us a little help here. Thank you.
That's fine. How's that look? Better. So really just point out again, if you took a snapshot at the end of the first quarter, markets were down 20+%. Just a remarkable recovery, over time. Actually, the fastest snapback from a bear market in history. We were down, 30+% at one time, and then we rebounded 60%, all in 1 year. We took advantage of that at the plan level, and you'll see some of that in your equity returns over time. But again, strong returns across the board. They continue. Inflation's starting to pick up a little bit, but the Fed is out there saying they're willing to let it run, keep interest rates at zero. Looks like we'll have another fiscal stimulus coming out, whether it's 1.9 trillion or somewhere in between, a trillion or so. That's all positive for the markets. On a executive summary, so again, part of what Phil went through, but again, so Fadi mentioned we're at 3.9-ish through today. This is through the end of the year, so 3.8 billion. You saw an increase of 274 million quarter over quarter. So strong double-digit returns feeding into that. On a policy basis, again, very similar, pretty much in range. Private equity is overweight. Again, that's good performance. You'll see that when we look through it. Since we've been on board, we've been, again, we're going to talk about some investments today. We pay some out each year, vintage year, but we've been trying to dial that back a little bit at a time to bring that back into closer range there. We should see that as we get more distributions coming through. On a performance basis, for the quarter 8.9, again, gross of fees ranks you in the 85th percentile. Again, 1 is the best, 100 is the worst. Shouldn't be a surprise for those folks that have been on the committee for a while. Anytime the equity markets, public equity markets rally a lot, we're going to be towards the bottom there because we have a lot less exposure to the public markets. And the opposite. So first quarter, you looked really, really well. You could see over time, the results have been strong though. 1 year, 14.4, 28th percentile, 3 and 5, 6 and 13th percentile. So you're basically top 10% relative to public fund peers out there. And those peer group is, plans with $1 billion plus. So they look like you could do similar investments and so forth there. A few notables, small cap. So in the public equity underperformed. The rally we saw was the lower quality names, particularly maybe some financials, some energy. Your managers focus a little bit more on quality. And as I say, quality as far as maybe definitely positive earnings, steady earnings. There's a lot of companies in the small cap index that don't have earnings. And those are some of the companies that rally the most. So you'll see a little divergence. And this is on a relative basis. We'll show you the absolute returns here in a minute. International outperformed. And then fixed income also outperformed.
Hey, Keith, Tom Curtis,
Yep.
Quick question.
Yeah.
Feel good about us relative to other public plans. Can you just give, I don't want to extend this long, but just real briefly, versus how do public plans on average perform relative to corporate plans? And then also to say some just larger pools of capital, such as a foundations or endowments?
Big question.
Yeah, not long answer. Just
I don't have it in front of me. So corporate plans are a little bit different. So we're talking about. I think Fadi mentioned. The actuary report's a little different. You guys are 7.25, I think it is. Corporate plans are using a different number to kind of discount into their funded status. A lot of them have done liability-driven investments. So really hard. They're going to be very different asset allocations there. But just performance-wise, are they? I think most plans are close. So E&Fs, you guys would probably be closer to E&F. You have that endowment foundation, similar model, a little bit more alternatives, less in the public liquid space. Yeah, I don't have them right in front. I'm sorry, I don't have them right in front of me. Okay. But like I said, corporates over the years, because this is hitting their quarterly balance sheet, a lot of them try to hedge that that discount rate movement there. The fact that those rates nosedive through the year, they probably had a stronger year than you per se.
Okay, on average. Okay.
Yeah, I mean, they'll use futures and then, they'll equitize that. So they picked it up on the equity side plus kind of that liability stuff. But hard to say. I play in the public fund realm. Per se. As a company, we see them all, but
got it. Okay, thanks.
and yeah, I mean, in the public fund space, you have some folks in, Illinois, California, and New York, relative to Nashville, who is very strong and healthy. 94% funded status is a very good number there.
Understood. Yep. Thank you.
So again, just some numbers to it here. So 3 months, you can see the pair group, 10 for the quarter. The 1 year is 12.5. Your plan was up 14.4. And you can see as you go out across the years, 9.4, almost just shy of 10% over the 10-year period. And then since inception, 8.9% there. So strong returns, just some bar charts here. You are the dark green, so that's your actual, the lighter green is versus the policy. So the extent that we're over or underweight, in this case, say we're overweight private equity, it's been doing really well. So that's going to help you look good relative to your policy index returns on that front. On a risk basis, so again, crosshairs up here, we do 3 and 5 years. Risk is across the x-axis, return is up to y. So the y-axis, so you naturally want to be towards the left corner. That green square is where you're plotting. The shaded area, kind of crosshairs, if you want to think of it, that's the 1 standard deviation around the median there. So you're well to the left. So you're basically earning a lot more return for the amount of risk you're taking. So risk adjusted returns. Another way to think of that is on the bottom page here. So the Sharpe ratio, you take your annualized return over your risk, essentially your excess return over risk, get a number, and your Sharpe rank is 1. So again, 1 to 100. In this case, we're looking at 374 other plans. You're ranking first versus these, 300. You're in the first percentile of these 374 plans. So on a risk-adjusted basis, look great. On a return basis, look good as well. And same story for the 5 years. Okay. Allocation versus target. So recall we made some changes last, I think it was June or August. I forget which meeting it was, but the biggest change is we're moving out of the hedge funds. So you can see still halfway there, 0% target. We move that from hedge funds up into pretty much mostly public equities, a little bit in the public fixed income space there. So you can see we're a little over and under, particularly we've talked about private equity. We have brought the pace down, but the performance has been really good. Once we start to see some good distributions, that should start to come in line, and we can work our way towards these targets a little bit more. Okay. Tom, to your question, not necessarily versus corporates or E&S, but versus other public funds, how do you guys stack up on an allocation basis? So you could see across, if you could see my marker here, so we go left to right, U.S. equities, non-U.S., fixed income alts, and so forth. On the bottom are the numbers, and in the middle you can see the median, and then you can see where Nashville's stacking up here. So for the first example, the first column is U.S. equities. The median public fund out there has 31.2% in U.S. equities. You all are at 17.8, putting you in the 86th percentile. So you're almost about 50% of the equity exposure relative to your pair plans. So when equities are up double digits in a quarter, your rank's going to lag with the opposite of that. And you can see you're much higher on kind of the private equity and the private debt and so forth. And that's a decision that was made kind of coming out of, 08 and 09. Let's not let the U.S. equity, the public markets really wag this thing around so much and be a victim to that volatility. You introduce private equity, private debt. A lot of that is contractual income. So that mutes that volatility. You're getting that consistent kind of income stream, on a monthly and quarterly basis there. And it helps to mute out some of the volatility you may pick up there. So you look fairly different to a lot of your public fund peers. And we'll just dive into some returns here quickly. We talked about the composite, so 3.82, your monthly and annual returns here coming through. Large cap equity for the quarter 12.5 versus 12.1. The 1 year 46.06 versus 18.4. This is the PIMCO product. You know, at the end of March, talked with Fadi and Tom. When things were selling off, we were running maybe 50, 60% exposure of the S&P market. There was a decision made to put that back up to 100% exposure to whatever the S&P is doing. We did it right at the end of March, and we basically picked up the entire ride since then. We obviously didn't capture a good chunk of the downside. So in your large cap space, you outperform by almost 28% for the 1 year. So that's going to drive a lot of excess performance.
But that doesn't make you exactly an advocate then of market timing, right?
Sometimes better be lucky than good. How's that?
I'm teasing with you. Well done. Thank you.
When it works, yes. Yeah.
Fadi made that. I took the decision to Fadi. But no, yeah, it was good timing there. Almost 30 points on, 400 million dollars there. Mid cap again, a little bit below for the quarter, for the year. Strong outperformance, beating the benchmarks by 13%. Small cap, same thing, a little bit lower here. I talked about that rally and kind of those, I don't want to call them junky names, but the lower quality, the more beat up, energy financial type stuff really rallied. Your managers don't have a ton in there, particularly William Blair, more growthy. So you see underperform for the quarter, but for the 1 year, again, double digits outperformance. International up for the quarter, basically flat for the year. A lot of value exposure there. And for those that follow the markets daily, value has struggled. Started to pick up in the fourth quarter, doing a little bit better in the first quarter. So be interesting to see if they start to produce a little bit more outperformance like your domestic folks have there. Hedge funds I'll skip. We're kind of unwinding there. Fixed income, it's a mix of kind of core investment grade credit exposure, some unconstrained. So, fancy way of saying let them go kind of anywhere as far as credit. Sovereigns, they can mess around with the duration a little bit, particularly with rates bouncing around a lot. You could see added 2.5 for the quarter, a little bit behind for the 1 year. And that's still, we took a little hit in March. Markets froze up pretty significantly in March until the Fed came out and said they were going to backstop everything. And then you saw a lot of those spread products or credit products rebound over the years. Fixed income alts as your private. We'll look at these in a different way. But again, you're going against a public market. These aren't designed to go up, 6-7% in a quarter. You want to make money relative to this public market over time because you're locking up your capital. And you can see over time you've added, 4 percentage points per year over 10 years. 10 points per year since January 9. Again, gross of fees, so the numbers be a little lower, but certainly you're getting paid for locking up your capital there. Real assets, you can see the returns here. Really the 1 year, that's energy. So energy took a hit. I think it was either March or April. At one point, energy, oil was trading like minus $40 a barrel at one point because tankers were full, storage was full, nobody wanted it. Say on a futures basis there. It's since rebounded, so hopefully that'll flow to some of your underlying numbers there. Private equity, if that number looks scary, again, the Russell 2 is up 31%. Your private investments aren't made to go up 30+%. You went up 10, and if you go over time, again, this is part of the driving that over allocation. I mean, you're up, over 10 years, you're averaging 610 basis points above the public markets, what you can get there, and then 3+ over the long term there. Okay. And then lastly, so these are time-weighted returns, the industry standard, and another way to look at private markets is IRRs, so dollar-weighted. We do that here. I'll blow it up one more time. So we do fixed alternative, private equity, real asset, and then we kind of combine them all. I'll walk through the top one just to give you a sense of what we look at here. So over time, your alternative debt, you committed $1.8 billion. 1.3 you've contributed, so as they call it down per the contract, that's been going into investments there. We've gotten back $866 million so far in cash, and then you still have, call it $780 million in unrealized value in the ground. So add what you got back plus the unrealized, you got 1.6. So you've put out 1.3 and you've gotten back 1.64 out of that. That gives you your multiple of 1.25. So that TVPI is your total value to paid in. So you paid in 1.3, So far, you got back 1.6 and change. That's a multiple 125. Your return per year on average, 8.57%. And then over here, we show this BC Ag PME. So PME is a public market equivalent. In this case, that equivalent is the BC Ag, so fixed income, because we're talking about fixed income here. So the way the computer calculates it, it says all of these, at each one of these $1.3 billion that you've paid out to the investments on the same dates, the same amounts, we would have put that in the public Barclays Ag index. Your returns would have been 3.9. So there's your kind of split there, 8.5 versus 3.9. So you made a lot more money going into privates relative to public fixed income. You know, next item here is private equity. Again, same story. 15.6 per year versus 11.8 in the publics. Real assets is lower. You'll notice we're comparing it to an equity index, so not exactly apples to apples, but there's not a really broad benchmark to kind of compare energy and infrastructure and real estate, things like that. But it's we're trying to put something out there, and then just on a program level, again, 1.4. So your multiple, every dollar you've put out across all of these buckets, you've gotten back $1.40 in value, just shy of 10% per year relative to 8.5. So added value. And then we break them out line item. I'm not going to go through them line item by line item, but we have all the details for all the underlying funds. And this will feed into some of the recommendations that we'll be talking about here shortly. So I'll pause, try to catch us up a little bit.
Great job as always here. It's a great report, a thorough one, and couldn't be happier with some of these results in the midst of all things pandemic. So thanks for all your hard work there. I know some of the others may have some questions, and I'll kind of go around the horn to make sure that they get a chance to ask those. So Christine, Tom?
Yeah, I have a question. So and I don't know if it's on this report or you'll touch on it later, but maybe I just want to bring it up in case you won't. On page 23 of the performance document that was sent to the committee, you mentioned there were several things that, you were looking at in terms of what impacted, and maybe it's a different document. I'm not sure, Keith.
Okay.
But anyway, let me just tell you what I'm talking about.
Yep.
Certain things that have impacted, what we're looking at as we move into the future. And some of the things you mentioned were, sort of the virus, the trajectory of the virus, the globalization of the economic stuff.
Okay.
And then you mentioned the China what's going on in China right now in terms of some of the volatility with the Trump administration, whether or not that will change with Biden. One of the things you didn't mention that I wonder why wasn't mentioned was cybersecurity as one of the things that the impacts in terms of our trajectory in the future. And one of the things you're kind of watching closely to make sure that, we keep up to date on that information.
Yeah, let me, I think you're referencing our 2021 capital market outlook probably, and I could pull that up really quick. So some of the things that you mentioned, hopefully, that's a good thing about the electronic is stop.
I'm sorry if this was something you're going to do later.
No, I don't think we were, but I will hit on it really quick though, just so other folks, hopefully it'll.
Christine, while Keith is doing that, this has been a really big topic, especially on the private side. Of course, Metro has its own IT infrastructure and security, but what I concern myself more with is the cybersecurity on the private investments. There's been a lot of companies and portfolios all over that were attacked and data taken hostage and ransom and so on. So it's a constant issue, and it's part of the due diligence on the funds. And quite frankly, it's also an investment theme that we have. Some of the companies, and maybe later in the report when I go over the update, I'll mention that some of the companies involved in cloud computing are major players in that space that we've invested in on on the venture capital side as well.
Yeah, and when I look at the things that could really impact the key market themes, I see in addition to the sort of virus trajectory of the permanent intervention, globalization backlash, the China transitions and what's going to happen in China, I consider that IT one a huge one that could really impact the market.
I agree with you. I agree with you.
Yeah, I mean, to Fabi's point, a lot of your underlying investments, particularly in the venture cap space, are you're capturing that. Probably why you're seeing a lot of very strong returns there. But for broadly, so each year we put out NEPC puts out an outlook, and again, to Christine's point, there's kind of 4 themes that we think drive markets. There's no really start or stop there. It's just kind of as they change and wax and wane, they do move markets. If you want to think about the first 2 is really, virus trajectory. You see dominant. Globalization is there. I mean, you're seeing that around the world as far as the wealth gap and, just a lot of things relative, government versus population, things like that. China, fairly neutral, dominant ones. So permanent intervention, we talked about it. That's both on the fiscal and the monetary side of things. I think the Fed essentially put their entire playbook to work in about a week. So everything they learned from 2008, this March, they put it together, a week and injected trillions of dollars of liquidity into the market. So we've been straight up since. And on the fiscal side, they've pretty much been doing whatever they need to do as well as far as doing that. So that's here. ECB, Europe, over in Europe, they're doing similar. Japan's doing similar. So we think that provides sort of a floor around your markets. And then as the virus goes, I mean, it's very dominant. You see that if there's good news on a vaccine front, markets tend to rally. If there's, new strains or, any type of other bad news around shutdowns or things, then you see markets sell off. I think the virus is still out there, but I think, people are starting to adjust a little bit better. You're not seeing huge swings in the markets like you used to, back in, summertime. We'd move around a lot. And then you saw it in November, once they announced, I think it was Pfizer and then Moderna came out, markets rallied, particularly small caps went up 30% off of that news there. So it's starting to settle in. Cybersecurity, I think does play into that. Whether or not that's going to move our markets per se, but it could. That seems to be the new frontier in a lot of different ways there. So yeah, I'll push that feedback back to research. So we have a dedicated asset allocation team up in Boston, a dozen plus people, and they sit around and think about these things. But I mean, to the virus is there, and to the extent these interventions they're intertwined a little bit. The worse the virus gets, the more money they're going to put in the markets. When do we pull back? When do we push a little bit more? So those are dominant themes.
I guess I get all that. And it was just a comment. But truly, if the United States at this point had a major intervention with other nations around cybersecurity, markets may go up. It may not adjust them, but it could. And that was or they may not. If nothing happens, if no one gets together and talks about it and works on it, I don't know. So it was just a comment on my part.
Yeah, no, it's a great point. I mean, if you pull somebody's switch off, you're gonna have some major issues.
Right.
Unfortunately. All right, so let me. So again, that's the outlook. I think it sounds like Fadi posted it. We can set up another time to talk about it, but we give our assumptions per asset class and so forth on that front. But I'll pause. See where we want to go next.
Any other questions here?
This is Tom Curtis. Question on kind of the longer end of the yield curve and kind of the compression of spreads between corporates and high yields and treasuries. Kind of where do y'all see that going kind of strategically?
Let's see. So here's our assumptions. So strategic, to your point, the treasuries, the 10-year are going to get you about a point. So when we do these assumptions, at a set point in time, when you look at, say, the 10-year note, whatever the yield is, typically if you look out 10 years, your return is going to be around that plus or minus. In between, there's a lot of noise there. We think high yield, you can get 2.9. So we think you could take on more risk. If I go back, so our major overview here, a couple things to that though. So returns are lower, higher strategic to equity targets. So we moved your targets up a little bit last year, and we're working towards that as we get the money back from the hedge funds there. Have some dedicated safe haven. That's to the point in March, nothing really moved. You can move treasuries, but that's it. You can move investment grade credit, any type of high yield. Everything was locked up until the Fed came in there. So you have some of this with PIMCO. You have a dedicated core, you have investment credit, and then that unconstrained fund can really move around a lot duration wise and see what they're seeing the markets are. But we think you should put on risk given where the rates are, given the stimulus. So our two major themes. This first one's dominant. We think they're going to do whatever they need fiscally or monetarily to keep these markets and these economies moving along.
So putting on risk would suggest, increasing high yield relative to treasuries on the long end. I mean, is that what you're saying? Because that's really more, I see that more kind of equity. And I would almost think just the opposite, quite frankly, given the tight spread.
Well, there's two ways to look at it. But again, if the Fed is out there and they're in the markets and they're serving as a backstop and they're buying investment grade credit, and I mean, this is the first time they ever did it. They've never gone out and bought, in 08 and 09, they bought treasuries and mortgage-backed securities to kind of keep the rates in check. This time they came out and said, we're buying credit, including high yield, if they need to. And they job on the market, they put it. So we think there's a floor under it. Treasuries, return-wise, don't look sexy. But on a liquidity basis, so if you hit another air pocket like March and you need liquidity, Treasury is a place to be. This plan held up pretty good in March. We saw a little bit of markdown, but there wasn't any major liquidity issues that really hit us or anything like that. So I think we have areas to draw on there. But yeah, we're in a
Tom,
for those people that are more defensive, we think you should get more risky. At this point here, we're not recommending any changes. I mean, we changed the target for the equities, but I think what we're doing is good. We don't, we're not saying go out and put on a bunch of high yield and all that stuff there. And Fadi,
okay,
too.
Tom, as far as the positioning and the plan right now, we have very little high yield in our traditional fixed income. There's 30 million in floating rate through Marathon, and we allowed the corporate credit portfolio with PIMCO to do about 30% in high yield. That portfolio is a total of 180, so that's a small amount. Overall, we're focusing on investment grade and low duration. The duration of our fixed income portfolio is about half of the 6-year duration of the benchmark. That didn't pay off well in March. When everybody ran for safety, but since then it's paid off handsomely. Now we don't emphasize liquid high yield just because we have so much in fixed income alternatives. We think those assets have a premium to the public market, and quite frankly, better terms that will have more protections for us, and the duration is significantly lower as well. So right now, what we're doing with distributions that we received from, we've received a lot of distributions, both from the private equity portfolio and from the equity long short liquidation. We have put very little of that in equity because we are above targets there, but most of it has gone into our traditional fixed income portfolio with about a 2.5 year duration, just to increase the liquidity and the safety in the plan.
Okay, thank you. So we're not doing much out on the long end of the yield curves. Was kind of where I was going with that. So.
Not at all. Quite the opposite. Correct. Yeah. We're very short.
Yeah.
Good. Okay.
Yeah.
Thank you.
Yeah, and rates have been moving up. That's why you've seen the markets kind of sell off the past few days with the volatility there. So.
Hey Keith, this is Christine, and it may be down in the weeds, and you can just say that. But Wells Fargo, at what point are we going to kind of deal with Wells Fargo?
I think so. Dan's on later. Dan, they'll be doing the Metro plan. I know there's been conversations with him and Fadi, and then the news where they're selling their, I think it broke yesterday, the day before they're selling. So yeah, that's going to be, there's already background conversations going there. Okay. So it's already kind of on the pocket.
It's coming up. It's coming up a little later. Thank you.
Okay. Thank you.
Yeah. Let me, so I'll jump out of that. And then Caitlin, do you want to pull up the memos, or how do you want to do this? Fadi, how do you want to do? You want to just hit the recommendations page before we get too close to noon, or how do you want to do it? You're on mute.
believe Michelle was going to speak to performance as well before we skip on to recommendations.
Okay. Let me.
Kevin, before we get started on that, I have a hard stop myself at 11 for a public meeting where I'm a speaker as well. So if we could, if there are actions that the board needs to take, let's go ahead and move to those topics so we can finish those by 11. And then I can turn the mantle over to somebody else to lead and chair after I depart if the meeting still needs to continue.
Okay, I'm passing back to Caitlin.
So given that, you know, I wrote the comments. I'm not going to dwell on the first part since they are written. We'll continue to do the risk reports. They're posted on the SharePoint. This quarter's risk report will be up next week. There's no major change. However, you can see the influence of the venture capital in our portfolio, because when we simulate a downturn like the tech bubble that occurred in 2000, we see that we will get hit, and it's not overwhelming, but we're managing that. But returns, quite frankly, have been really good from that space, and the distributions as well. But with that, we're going to move on to the private equity portion. And basically, Keith, do you want to go over, I'll go over this real quickly, the headline, but you want to go over the report for the Axiom Asia Fund? You can maybe bring it up while I'm talking.
Okay. Yeah, I would just point out, so as we've done in the past, and a lot of these are re-ups with managers we know already. So we've put together the memos. I'll bring up Fadi could talk to it, and I'll pull up or Caitlin, I think you're driving if you want to pull up the memo.
So as background, while that's happening, we use Axiom Asia for their basically emerging market private equity. It is primarily growth private equity, although they say buyouts and venture, it is primarily growth. And they also have some complementary strategies. One is a co-investment fund that is for a lower fee, goes along with some of the co-investments. So we have two vehicles today we're recommending that are not the fund of funds. We already invested in the flagship fund last year for $40 million. Normally we invest $20 million in the co-investment fund. That's what we did in co-investment number one. But this time, because they're also rolling out a direct secondary strategy that we'll talk about here in a minute, we have split the difference. Basically, we're recommending $10 million into the direct co-investment and $10 million into the other fund. So with that, go ahead, Keith.
Sure. Just again, time-wise here, just high level, to Fadi's point. So fund 2 here in the series, we invested in fund 1. That's moving along. It's 2.5, 3 years into the life there. If you walk through really the second paragraph here, this is an extension of Axiom Asia Fund 6, something that the plan put $40 million into. They're going to do co-investments to the extent that there's deals where they need to put, or the managers are working with need to put more capital into specific companies. So a growth company in the tech space there. So very attractive, whether it's fund limitations. So again, the broader fund we're in can only do, up to 20% of that. They hit the border here. And as they talk about, this is an overflow vehicle. So we're going to be allocating more capital to, highly attractive, specific investments. That'll flow out from the managers that they're invested in. Happy to go through the memo a little bit more detail. Again, it's Fund 2 of the series. Again, we put together this, double-digit type return. It's a 1-rated strategy on our platform. So some of you met Harry Carnish. They'll do the write-up. It'll roll through our research. And we have ratings from 1 to 5. 1 is kind of the best idea in our space. So really just continuing along the path here. If you look at your program, we try to find managers we like, that we know, that do good returns. And as they come back to market every 2 or 3 years, we continue that relationship and continue re-upping with them. And that's what we're doing in this case. So we're looking for up to $10 million.
Keith, I know we're in a time frame, but really, real quickly, did the first fund that we invest in, was that mostly in China?
Yeah.
This fund is predominantly in China, although there are some other Asian countries.
Yep. So Axiom, if you read through it, the very first or second sentence there, they're one of the two largest players in Asia.
Right.
And if you think Asia, China is a good bulk of that there. So this is a way. So we do.
60%.
Yeah, we do. So Greenspring does a lot of the U.S. type exposure. Axiom is kind of where we're getting our emerging market Asia type exposure. And again, you've done several funds, the broader fund of funds, and then these co-investments are really just a spill out because there's really good investments. They need more capital, and this is a way for you to get bigger bite sizes. So I'll pause.
Are we taking these two funds together or separate?
We're gonna vote on them separately. So the recommendation is to approve up to 10 million into the Axiom Asia Co-Investment Fund.
Well, this is Tom. Go ahead, Kevin.
Oh, please, I'll go next.
Okay. Well, I was going to go ahead and make a motion to approve that, and maybe somebody have a second, then we could have a discussion on it. So
I'll second, and that way we can move to the discussion.
Yep. Thank you.
So, Christine, interested in your thoughts about the meeting there, particularly your comments versus China. Any thoughts here?
Some comments about China too as well. So go ahead, Christine, I'll follow.
Yeah, I'm always concerned a little bit about China. The whole issue with the government there and the notification most recently at the Wall Street Journal and other places about them not being able to sort of utilize our exchanges, or may or may not be able to, the fluctuations in the currency. So I worry about that. On the other hand, the government's so in charge there, but to just avoid them because it is a risk, I think. And I think China may become more of a risk. But
This is Stephanie. I'm sort of in that same mindset. My hackles go up when we're involved in China, but I'm also hearing from Keith that we have other investments that we've done without knowing. And sometimes corporations, we get caught up in those fine details of things. And next thing you know, we're being criticized because of what's happening in China, and to know that we're investing. So I have a dilemma because we have done some, and and this is a continuation of another, but I have some strong objections with us getting to invest in China because of the government and what's happening over there. So,
Dr. Bailey, just to think about that a little bit, is your remark saying hold the positions you have today, and let's wait and see about investing in China another time? New dollars.
Say that again. Someone's on, and so I'm getting feedback from somebody's mic being on. Say that again, Kevin.
Yeah, I just wanted to make sure I captured the essence of what you're saying. Is that are you just recognizing that we have investments in China today and we can hold those positions, but in terms of any new dollars, you'd have trepidation about that and would not favor any additional investments that involve China at this time?
I think that is accurate. I think that is accurate. Yes.
So, Tom, Christine, any other discussion about that before I comment?
No, well, my general view is try to take the politics out of this, and I think that we're with a very good firm that manages money, and I think they're getting the money now, so they're very aware of, or would be getting the money now, so they're very aware of the current issues out there, and I think the smart team would be very strategic in it. So Asia's done pretty well in the last year, actually, at least some that I've seen, and I thought that this is a good crowd that's being pretty adept and would handle it well. And I totally respect the comments on the view towards China, which I'm not in favor of what they're doing, but these are multinational companies and such, so I believe.
Well, we can't, we may take the politics out. China's government is a type that insinuates and takes over and that sort of thing. So you can't predict them. It's what my issue is. It's not so much whether this is a good firm and they'll invest well, but the dynamics coming from the government of China are quite different from a perspective that we might have. So, and I'll leave it.
And I just think we've been dealing with that for years or decades. I mean, that's the environment we've been investing there for a long time. So it's, it's just, I don't think it's true. I think it's a reasonable amount for us to do. And the expectation on it should be a pretty high return. So anyways, but I can go either way. That's just my general thoughts on it. Respectfully to everybody on the committee.
Yeah, this Christine,
Yeah,
choose between the first and the second investment opportunity. I have more concerns about the second one, just because the managing partner there's only one managing partner with significant secondary lending, secondary direct experience. And so I just had a question about that. I mean, I'm a little more comfortable with, I don't know that we can put our head in the sand as it relates to China as much as I'd like to. Completely. I do have concerns.
So let me jump in here a second, and I totally understand the comments, and I share some of those views. We looked at this issue quite a bit when we invested $40 million into the fund of funds, and the focus of this team is to invest in local companies that are basically feeding off of or selling to local consumers. These are not export companies. These are not military contracts. These are basically the emerging consumer in China. We have about 300 million people in China that are living on a standard that's at par with the U.S. and another 600 million that's living below that, but they are underserved. And whether it's from baby food to whatever it is that kind of serves. And these guys are based in Singapore. They invest all over Asia, and they look at the Chinese opportunity in the context of the entirety. And I understand that there might be some reason to be apprehensive about China, but just keep in mind the risk to us from China is not just coming from what we invest in China. Quite the opposite. We have very little invested in China as a percentage of the whole portfolio. But if China turns south or some of these bad scenarios that you're imagining happen, the entire S&P 500 will get hit. Our private venture capital investments in the U.S. will get. China, whether we like it or not, is part of the global consumption system, supply chain, you name it. So I think I think history here would show us, and I can go back to the 80s when most pension plans pulled out of investing in China, including the state of Tennessee, out of fear that they're taking jobs or whatever the issue was back then. And I don't know how this will resolve itself. I'm not a political analyst, but these are real companies that are selling to real consumers in China. And quite frankly, I think this is becoming necessary in a portfolio because that's where the growth is. And we're looking at our markets are very overvalued, and we're just kind of trying to opportunistically diversify the portfolio. To put it in perspective, this is $20 million out of roughly $700 million that's invested in private investment. So even if you add up what we have in Axiom Asia Fund of Funds, it doesn't come up to $100 million out of the 700. So if we were to allocate to China based on their size, the commitment would be much higher. But I understand and respect your views. I get it, but I'm not sure that we can deal with it in this way.
But let's stop for a moment. I've just got a few minutes left before I've got to go to another public meeting, so I'm going to call the question here in just a second. But before I do that, I see where Michelle Bosch has joined. And Michelle, we said some very kind things about you while you were off to the closing call of the bond deal. But now that you're back, is there any comment you want to provide on this topic before we move to a vote? I've regrettably got another public meeting. It's going to start at 11 o'clock.
Well, I think this topic brings on a bigger item that we need to discuss that we all should have a separate meeting for, which is our risk tolerance and responsible investments in general. I think it would be useful to have a country mix, that sort of information provided in this investment report, which we'll work on. But essentially, that's what it comes down to is how hard are we driving to go towards the yield requirement versus how responsible do we want to be with the portfolio? And so as a committee, you need to think about that yourself and feel comfortable with that, and then base your decision on that.
So I'm going to provide a little perspective here. I agree very much with what Michelle said, and I think the last meeting or so we had, prior to President Biden taking office, new administration, new Congress being seated, this wasn't in the forefront of my mind on a geographic basis like it is now. But as we've seen those things come around, we are starting to see some geography creep into our economy at a faster rate than we were seeing previously. And there was a lot of noise under the Trump administration and so forth about various things. But here, it's apparent to me that the Biden administration is really reaching out to European countries, a number of African countries, Canada, and so forth, that have been good, longstanding, reliable trading partners, and is at this moment, I think, still evaluating its position on China. And I think that maybe magnifies some of the concerns that we have here, not because something bad is about to happen, but just because we don't really know what that position is going to bring in terms of its uncertainty. So I'm going to call the question here in just a second. I'm going to vote no, simply because of what I just mentioned there, and nothing further. I don't want to make any more of a political statement other than to say it's very interesting to me that a new administration does bring some geographic notes to us, and I think it would be ideal when we come back to our next meeting to have advanced some analysis like that. It's a new topic. I think it'll be an exciting one and a good one for us to delve into at this point. So I'm going to go ahead and call the question for a vote here, and I'll just go in the same order here. Christine?
I vote yes.
To move forward. Okay. Dr. Bailey?
I appreciate what Fadi said and both what Michelle says, but I'm going to abstain on this at this point.
Huh?
Yeah, I've got a question on that before I vote. Kevin, are you saying that from your perspective, and Michelle, from yours, we need to kind of relook at our policy on countries that we're going to invest in, or would have, with that?
Just since I made the last comment, I'll jump into that. I think we, at this point, could be thinking a lot more about geography here. And when I think about Asia, whoever said early on, China is a big, important piece of that, to be correct. And it's just interesting to me that, the change of U.S. presidents and not knowing yet what those policies are likely to shape up to be, that, now is the time maybe to hold the positions we have, but not advance any other dollars until we're a bit more clear on that. And to me, it just brings forward what Michelle said, that maybe that's something new here with this committee that we need to think more about than we have here in recent history. That's
and
it.
I guess my thinking on this is just kind of rehash a little bit of it, is that, if we're giving them the money now and they will have it over the next 7 years to invest, or several years, they will be investing with that knowledge of what the current administration will be doing, correct?
Oh,
yeah. So I wouldn't think they'd put it all in, put it to work all immediately. So it's an interesting thought. And Fadi or Keith, how late is this program open? When does it have its final close?
Keith, do you have an exact date? As far as I know, this is going to be a one and done close for them. I mean, their performance, they've been providing investors with performance that's 3x. I wasn't aware that everybody wanted to look at the exposure to China. I can tell you it's very small. If you can look at the risk report on Barrel 1, the currency exposure is around 1.54%. Now we have a little bit more than that in actual exposure, but it's very small, and relatively speaking. I think the co-investment fund is going to be very quickly taken up by current investors. I'm not sure about the opportunity fund.
Buddy, I'm sorry to stop you, but I have got to go to another meeting. So, Tom, have a vote here?
Geez, I don't know. And I guess if I don't know, that means I probably shouldn't do it. So I guess I would just say no at this point. But I'd really like to have this discussion, see if we're going to be driven policy-wise versus anything relative to what's in China, and do that from a committee overview standpoint, if that's.
One thing I want to just jump in here.
Hey, Fadi, I'm sorry to cut you off, but I've got to go. So I'm going to vote no on this, and so that'll be defeated for this moment. But what I will do is get with Fadi and Michelle and others, and why don't we have a special meeting here in a few weeks, and between here and there, we can do a little bit more work, and we can all think about this topic and then come back to it. Tom, Michelle, Tom in particular saw me do this recently with another investment thing over the Employee Benefits Board. It had some benefit to it here. So again, I don't want anybody to read any more into my comments here about this, other than we just have a new administration. It's just unclear to me, what impact that may have on our investments, and it's due some more thinking. So there's good analysis here. I did have a chance to review all this before now and do some other things in and around that economy. So I'm going to hand the baton over to Christine. First on my list here to continue with the meeting, and I don't think there's any other action items here that require a vote, or at least require me to participate in a vote. Is that correct?
Yeah, we can. I think we can. Yeah, we do.
I'm sorry to run, but some of these public meetings are pretty particular about the start and stop. So thank you all for participating. I'll look forward to the next one.
Thank you.
Thank you. See you, Kevin.
Thanks, friends.
Bye-bye.
Thanks.
So that was a 2-1 vote. And if we move to the next item, Axiom Opportunity Fund. I have a motion on that so we can have a discussion.
Yeah, so moved, Tom.
I'll second, Stephanie.
All right, so my concern about this Axiom Opportunity Fund is pretty much the same. In addition to the fact that I was a little concerned about Alex Lee, at least the write-up about him, in terms of if he exited that management team, what would happen to that fund. So it's all of the things that we talked about initially, and then it's that. Anybody else?
So,
okay, Fatty, so what percent of this fund is actually in China as well? I guess we don't know which secondaries we're going to purchase, correct?
Right. We expect quite a bit of this to be in China, this fund specifically, because the secondary opportunity right now, the direct secondary opportunity is present in China. This fund is relatively small. There's only going to be a handful of deals. And so there is not a large team dedicated to this fund, but this is a fund of this firm. So they will source deals through all the other relationships in the other funds, and so that's that. I mean, you will not have more than a handful of deals in this probably, and it will probably be mostly in China, and they will be at a very low price relative to what they're been trading at privately, because these are funds that are generally been around for a while, and the GP is looking to bring in a new investor to provide liquidity for the existing investors at very attractive prices. We have not done direct secondaries with, direct secondary funds specifically with Asia, with Axiom Asia. They've done just a few deals in the past in their fund of funds. We have had a lot of success, however, doing this with the Greenspring Group and other fund of funds based in the U.S. when they have a large platform. They have the talent and the sourcing. Really, the sourcing is the most important. To actually get in on the most favored list to be chosen to buy an asset from a GP, and that's really why we decided to split the two. I can't predict the returns in the future, but we thought it was worth pursuing this opportunity right now just because of the decline in March caused a lot of funds to want to increase liquidity.
Yeah, well, I feel like, Asia and China will be good places to invest from an economic standpoint, but I do think if we want to review, ESG policies for our pension plan, I think we need to have those discussions in light of before we make some of these types of decisions, because the governance issues may be something that we have problems with, should we decide to kind of go that route. So, I think this kind of follows the other one, and I would. But is anybody going to take a vote on this, Christine? But I'd be inclined the same way as on the last investment, just for those reasons. But I do think the committee needs to look at our position, kind of ESG issues that we would have, and we need to just have a good, thorough discussion on that.
So we can go ahead and call for a vote, unless Dr. Bailey.
Based on that, I would really just go ahead and withdraw the recommendations and let me just go back with Keith to the drawing board instead of getting a negative vote, and just follow up with Michelle and decide how we want to go forward in analyzing the country exposure, and we'll come back as directed.
Yeah,
that sounds great. Thank you, Dottie.
Yeah. Yes.
All right, so let's move on to the Greenspring recommendation. Keith or Dottie, you want to talk about that for a moment?
Sure. So similar to in the past, there's a memo. I think Caitlin could probably pull it up for you. So again, Greenspring Growth Equity Vehicle 6R, and as Caitlin starts to work through it, we will be investing in the fund. The fund is called Redpoint Omega. Well, let me back up. Higher level, Greenspring, just how we're talking about Axiom, kind of fund of funds in Asia. Greenspring does a lot of venture capital fund of fund investments in the U.S. So fund to fund is, let's say they go into 10 separate funds. Each one of those funds has 10 companies or investments. Your underlying exposures are, 100 different investments across those 10 funds. As a plan, you've been investing with Greenspring in their broader fund-to-fund products over time, and then certain underlying firms that are really hard to get access to, particularly, more than likely we wouldn't be able to do it on our own. Greenspring has worked with Nashville to do so. Redpoint Omega is one of those funds here. So, second paragraph, founded in 1999, 20 plus year history. 10 plus venture capital funds. So there's a knowledge base between Greenspring and Redpoint Omega there. So they're creating this vehicle, Greenspring GE6-R, for us to get additional exposure to Redpoint Omega. So we have some already in the broader fund to fund through Greenspring, and Greenspring's assisting Nashville to set this up to get a little bit more exposure to Redpoint Omega, who's a strong performer over the years. I think it's the tune of $7+ million there. So we put the memo together. We rely on Greenspring for their diligence for Redpoint Omega. With that said, we've done our diligence on multiple Greenspring funds, so we're comfortable with the way the operations, their diligence, and we've actually recommended multiple Greenspring funds, not only to Nashville but across our clients here. So, in essence, they are helping us out, creating a vehicle to get access to a really strong team that otherwise we probably wouldn't be able to do so.
All right, so can I get a motion?
I'm going to move approval of this. This is Stephanie Bailey.
And Tom Curtis will second.
I have a motion and a second. Tom? How do you vote?
Yes. Tom Curtis, yes.
Stephanie Bailey, how do you vote?
Stephanie, yes.
And I vote yes. So we'll move ahead with the Green Spring recommendation. And next on the agenda,
I think Blue Bay, or yeah, Arcmont.
So back in 2018, we were looking for. We've done lending quite a bit in the past, as you know, and the funds that we get into oftentimes have higher fees, and we're not able to control some of the risks. So since our exposure is relatively high, we created separately managed accounts. That's what SMA stands for. One for the U.S., which is not being discussed today, but this one is specifically for Europe. We selected a firm named Blue Bay. It was held in a Canadian bank, and since then they've gone private, so they're independent now, and their name is Arcmont. We have $80 million committed to Arcmont. If you recall, about 2 quarters ago, after the March incident in the market, we expanded their mandate to increase 15% and more opportunistic or rescue capital. We've been following the portfolio closely. It's fully committed to $80 million. And we would like to, at this point, add to it $20 million so that they can continue to make new loans. And once they use up this $20 million, we will probably review the portfolio again and come back to you. But for now, what we're recommending is to increase it to roughly, so have a total commitment of $100 million, an additional $20 million to invest in Arcmont, Nashville's SMA. Generally speaking, we're getting about 150 basis points more on the loans than we would have back in March, or prior to March, in 2019, because the banks are limiting their exposure. We had very little. Even though we were investing prior to the pandemic, we did not have any negative outcomes from the portfolio. So with that said, I'll make sure Keith gets his say here.
Keith, do you have anything, or should I?
No, again, I mean, this is an existing investment that, we did the work on and the opportunity to put the $80 million to work. We took a chunk of that to Fadi's point when we saw a little bit more distress in the market. We peeled a part of that out from not strictly lending, and now, we're going back saying, let's put an additional 20 million in there. The case for, and this is why we started doing the SMAs, is because we could have flexibility around the timing, review the portfolio, be aggressive, or kind of dial back a little bit there. So it's already in your plan. We're just looking to do a little bit more of it.
Okay. All right. So
Can I get a motion on this one, please?
Yes.
I'm ready to make a motion to Stephanie Bailey.
Thanks, Stephanie. Appreciate it.
I'll make a second, please. Tom Curtis.
All right. We have a motion and a second. I'll vote in favor. Tom Curtis?
Tom Curtis, yes.
Stephanie Bailey?
Stephanie Bailey, yes.
And Christine Bradley is a yes. So that passes. And next on the agenda?
Christine, this is Tom Curtis. Can I ask a question, since this is, I think, the last we have to vote on, correct?
Yes.
Yeah.
So if we go back to the original one, on the Axiom, the first one that was voted to not invest with them, I don't think we need to change the vote at all, but I think just given that we withdrew the Axiom Opportunity Fund, just for really more potential policy issues, I would hope that it'll be noted that Axiom, I believe that vote was, the policy issues had something to do with that as well. So Axiom doesn't feel like we didn't think it was a good investment. It was just the nature of the investment, so to speak. Is that appropriate to put that in there or not? Just leave it the way it was?
I think since you said it, and this is part of the meeting, Tom, I think that we can put that in there.
Okay. Well, that's, unless anybody disagrees, I think that if that was a request for the opportunity fund, I would really think the co-investment fund falls in the same basic area. So just kind of, I view that as the reason for that. So.
Okay. So my understanding, and forgive me if my audio is a little off, but my understanding is that before we pursue something like that, we wanted to do a country review, like Michelle said, and look at basically where we want to invest. And that's what I'm going to tell Axiom.
For both, yeah, I view that was the reason for both of them actually, but we did vote them down. Yes, we withdrew the second one. We actually voted down the first one. So,
Caitlin, do you have that wording?
Yes.
Caitlin?
Yeah.
Okay.
Got it.
and coming out of that discussion, do we also want to have not only just a country discussion, or does this get to the larger just our policy on ESG? Michelle, Fatty, do y'all have any thoughts about that? Do we want to revisit that?
Yes,
well,
this is exactly what we talked
Yeah.
about earlier. And earlier this month when we had our conversation is reassessing our risk tolerance amongst the committee. And obviously ESG is an aspect of it that is taken, as you already know, a lot of traction.
Yep.
And, essentially we are electing ESG by the way that we invest. We don't have to per se go to a responsible fund to make that election, but we just go by picking, but that's just a subset, I think, of the bigger question is I think we should have the discussion about responsible investments, and where our floors and ceilings lie for certain risk appetites.
Right, I agree. So I look forward to that discussion. I think it's a great one to have. So thank you. Okay, sorry, I just want to kind of clarify those for me and know where we're going and kind of the scheduling on that. So that'd be great. Look forward to it. Thank you.
Thank you. All right, so let's move on to our next agenda item, the pension performance. Let's see, where are we here?
We're on the Metromax review, so
Metromax.
Yeah.
Yes.
7.
You can give control to Dan, I believe.
Yep.
Okay, I'll pull up my report here. Can you guys see that okay? Oh, hold on.
Yep.
Go.
Search book. You'll have to stop.
So,
If you can increase it, that would be good, a little bit more.
sure. Better. So for the Metromax 457 plan, the plan today is to go over the Q4 performance report, and then the target date funds. I know Christine asked a question on Wells Fargo already. Today we've provided kind of a quick review of other defensively positioned target date funds, which is similar to Wells Fargo. We think that the next time we should do a full search to consider other managers in that space. So that's the kind of high level of the topics we'll cover today. We have the fiduciary calendar on page 2. So if there's any other items you want to see throughout the year, we have a kind of a schedule of events to come. But if you, as you look at that, if there's any other items you want included, certainly let me know or Fadi know, and we'll make sure that's represented in 2021. Jumping quickly just to the executive summary of the plan. Plan assets are up at $383 million at quarter end as of 12/31. That's up $31.5 million over the quarter. In terms of participant allocations, the core funds still make up 90% of the participant allocations, and then 10% are in the target date funds. That's the Wells Fargo funds that we'll go into a little detail on in a bit.
Dan,
yeah,
you have to stop sharing and click on that other PDF and then share it again.
Oh, okay.
We're still just looking at that one grid. Yeah, you got to kind of back out and then click on your report and then share it again. It's a little different than Zoom. That's fine. Okay, well, we had it there for a minute.
Try it again, sorry.
Is it the same report or 2 reports?
It's just one report, so let me
Okay.
see if I...
There you go. Oh.
Not sure why it's going away. Oh, okay, let me try the monitor itself. Sorry. How's that? Does that stay?
Yeah. Now I think what you were talking about. Yep. Good. Thanks.
Okay. Sorry about that. So anyway, looking at top left again, assets are up 31.5 million. 10% of the plan assets are in the Wells Fargo target date fund. That's about 37 million of participant assets there. In terms of plan performance for the quarter, Keith already touched on the markets. The 457 plan, of course, experienced most of that upswing in the market through the whole year, but in the fourth quarter as well. You can see the range was anywhere from the stable value fund up about 70 basis points to the small cap fund up over 31%. And then target dates are up anywhere from 5.1% to 14.3%. So really good quarter of performance in the fourth quarter for 457 participants. Mentioned we did have a slide on the target dates. I'll just touch on quickly just the performance, and this is on page 7 if anybody's following offline. Wells Fargo, their current team for over 3 years. So their style that they have today, which is an index style that also is an enhanced index that focuses on momentum, quality, size, so small cap focused, and then value. So as Keith mentioned, value's been challenged the last couple of years and going on almost over 10 years now, where growth has outperformed value. So the style of Wells Fargo has not been in favor in that time. That they're also defensively positioned with regard to their glide path, so that's impacted them as well. I think though the perspective that I have, and I spoke with Fadi about this, is there are other defensively positioned target date managers that have performed better in the last few years. So Wells Fargo used to be the extreme end of that defensive positioning. Their relative weight from equity to fixed income was a lot lower than peers. When they brought in this new team, they've since gotten a little closer to where the market is. So back in 2008, they were the best performer in the category when markets crashed. In the years after that, though, they trailed just about every year as the equity markets recovered. And so now with their new team and their new approach, they're a little bit more in line with the rest of the market. And we'll look at just kind of equity allocation for one of the funds. So some perspective there. Also, too, some breaking news this week. I think Keith talked about how Wells Fargo's asset management arm has just been purchased by 2 private equity firms. Our research is still working through that, and we should have a rating on that at some point in the next week or so. And then I'd expect there to be some firm level watch rating attached to that at the very least. And so all this kind of pushes us towards doing a search to kind of look at other managers and make sure all committee members, if we are going to continue with Wells Fargo, are comfortable with that, given their structure and how they compare to other funds.
Thank you for that, Dan.
Yeah, I'll jump forward just to quickly before I just give you a little more detail on some of the alternative target date managers. One note I did want to point out for Vanguard Prime Cap. Last meeting we talked about their underperformance in the beginning half of 2020. That was tied to their holdings in airlines and some of the other travel stocks they held in their portfolio. In the fourth quarter, they did rebound. So since the last time we met, they're up, beating their benchmark and near the top quartile among peers. So they've responded. That's continued actually in 2021. So this is as of 12/30/31 at the end of the year. 2021, they've been one of the best managers in the large cap growth space. So they have recovered. Still a bit of a ways to go, but positive performance trend for them so far in 2021. So again, we included some target date comparison slides. I think the goal, and this is a lot of small print, so I'll try to kind of signpost for you. What we've done is taken a few of NEPC's preferred target date managers, ones that we like. If we're going to do a search, these are the managers we profiled to you. And just to kind of show their asset allocation for the 2025 funds. So Wells Fargo is somewhere around 51 to 52%. allocated towards equity. And you can see most of the managers are fairly close to that equity allocation. The extreme end is Vanguard on this page is 59%, but all within somewhere between 50 and 60% equity allocation. So we look at Wells Fargo, we know they're defensively positioned, but other managers are taking that similar defensive position as you get close to target date. And if I flip the next slide, you can see the performance comparison on that 3-year number, again, with the current Wells Fargo team. You can see all these other defensively positioned managers have outperformed. So there is some kind of some more to the story there with the positioning of Wells Fargo and their value tilt. But again, we think there's some opportunities to see some better performance. And also too, if I flip forward, and I'll pause after this for questions, there is a kind of a compelling fee thesis too that we could look at. You can see, Wells Fargo is at 14 basis points, and then there's a couple other managers that would represent a lower cost. Now this is just their institutional share classes for most. We'll do a deeper dive and do a full search and get the best pricing from each manager for your mandate. But State Street and Vanguard both have 9 basis point options that are available. So settle out there. Let me pause. I know we're behind, so I don't want to ramble on too long.
Yeah. So this Tom Curtis. So when are you going to start doing a search?
So we'll conduct the search now. Our research will reach out to the managers, get their pricing, and then we can bring them back to you all at the next meeting. So
okay. Thank you.
So are we in agreement as a committee that you want us to do a search? I just want to make sure we're not assuming that.
No, I would really like to see you do a search. I think Wells Fargo has underperformed for a while. We need to do something about it.
This is Stephanie. I agree.
Okay, thank you. So I think that especially in light of the fact that Wells Fargo is selling their investment division, and also, Dan, can you talk a little bit about Vanguard allowing smaller plans? That's kind of, for me, that kind of tipped it over the edge even before I knew that Wells Fargo was going to be selling off its assets.
Yeah, and I didn't mention that Vanguard recently just lowered their minimums for their institutional share class. So previously, the best share class you could get in terms of pricing was anywhere from 12 to 15 basis points for the different vintages. Now they've opened up their institutional share class at 9 basis points to anybody over 5 million. So the plan would qualify for that share class. So that's another compelling reason in terms of, it's not just their approach, but also the messaging. If you did move to a new manager, someone like Vanguard, you could give, the reason of lower cost is another good reason to make a move as well. Any other questions there for me? And okay, stop sharing.
Thank you so much. All right. We could go back to the agenda.
Dan, if you will make me the presenter, that would be great.
Christine, I will have to leave at about 11:30 to.
Okay, we're going to try to.
Yeah.
We have really gone over here, but that's okay. We've had a lot of good things to talk about. Caitlin, you want to show me the agenda? All right, so we have the next is the Metromax. John?
Yes, can you all hear me?
Yes.
So yes, thank you, Christine. And I'm gonna let Caitlin just run the slides for me, as she's a lot smarter than me. Okay, here you have your Metromax team. Just a reminder what we look like. You got Delta Hayes, and she's on the phone with us from Houston, where she has survived the winter blizzard down there. And you have myself, you have Whit Gorham, Lisa Metzel, and Seth Crosby holding down the fort over on our 2nd Avenue office here in Nashville. You all know we were affected by the explosion on the Christmas day, but our building is still sort of a construction zone, but the Voya offices themselves are fully operational at this point. Next slide, please. Just going to hit some of the top items here. Number of site visits for Metro departments in 4th quarter remains at 0 due to social distancing concerns. Call-ins way up, walk-ins way down, and those are socially distanced. Many folks are actually walking in. Appointments, orientations, seminars, all greatly affected by COVID restrictions, but I think we're making up for it either via telephone or Zoom calls. That's why we have all those asterisks running down there along your total numbers, because those are virtual or socially distanced interactions with MetroMax participants. Next slide, please. A couple numbers to hit here. Enrollments for the year, we ended up at 457. We're about 25% off of where we would normally be. I'll take it. It was a bit of a roller coaster ride for getting those enrollments because of COVID restrictions. But we know there's a lot of pent up demand out there, so we're hoping that 2021 will be a better year for that. I will point out that the COVID related distributions as allowed under the CARES Act, we ended up at 195 total distributions at 1.8 million. The window for those CRDs, for those distributions, closed on 12/31. Don't know if that window will reopen. There is some talk about extending the CRD CARES Act provisions into 2021 under the new administration. Don't know if that's going to happen. We shall see. We'll point out that the rollovers from the outside plans and the drops from the Metro pensions brought in an additional $8.3 million to the plan. Next page, please. Just going to run through these quickly. MetroMax participation and 5-year look back. Just want to tell you all we're at an all-time high as far as participation at 7,700. About 5,000 of those folks actively contributing into the plan. Really good news. Not surprising. We see that folks, once they're in this plan, even if they retire, they love staying in here because of the service, the investment options, and the low pricing plan. Next page, please. Payroll contributions, another all-time high. More good news. Contributions up almost 3%, 14.3 million all-time high there. Next page. Dan hit on this. All-time high. We're up almost 10% year over year at 9.8% up year over year. 383 million, inclusive of all contributions, distributions, including all those COVID distributions. Spoiler alert, I will let you know earlier in February, we topped 400 million for the first time. This page here shows you a pie chart of what Ian was talking about, just another visual for you here. We've added some more detail this time, looking out some investment names, some dollar amounts with some various asset classes for you, hopefully give you a good visual of where the plan assets live inside of MetroMax. Any questions about that? And then page 9, please, Caitlin. Our average participant account balance by age band. Got some good news for you here. The orange bar is MetroMax employees. The gold is the Voya benchmark of all government plans across the country that we have. So if you're reading left to right, as you know, you got your millennials on the left-hand side, you know, folks like myself. Then you have your Gen Xers and your baby boomers. And MetroMax participants are above benchmark in 4 out of those 5 age bands. And you look at the 60-plus folks there. This is notably average account balance in that range just topped 100,000 for the first time. So that's good news. And it's about 23% above the national benchmark that we have for folks in that category. So really good news for our retiree or near retiree folks in that category. And then lastly, last slide, Christine, you touched on this, Fatty touched on this about the constant threat of cybersecurity. So this just happened to be the highlight slide that I like to, show y'all every once in a while what's going on the technology side of things with Voya, is we really want to build confident investors. We want to get them obviously enrolled in the plan, engaged with the technology and the financial wellness tools and all the calculators that we have. We really want them to be confident in their investing. So we've rolled out the Voya Safe Guarantee. We did this a couple of years back, but it just bears repeating. Safe Guarantee, SAFE is an acronym. SAFE accounts for everyone. And the way it works is if any assets are taken out of your MetroMax account due to unauthorized activity and through no fault of your own, okay, so it's a bit of a two-way street there, we'll restore the value of your account. But we want you to do a couple things. We want you to register your account online, create your user ID and a strong password. That's going to make you do that. That's good. Keep your contact information up to date. Let us know if you get hacked, identity theft, or if there's some sort of unauthorized activity. You need to let us know. And then just practice safe computing habits, real make sense stuff like, don't share your password. Don't post your password on a Post-it note on your computer. Don't get involved with scams and, Nigerian princes trying to move money into the U.S. You do those kinds of things, and you practice safe computing habits, and your account gets hacked. We're going to make you whole. Okay. So again, this is just one way that we want to protect MetroMax participants and keep them engaged and keep them confident in their investing is through the Voya Safe Guarantee. So that's all I have for you guys today. Thank you very much for your time. Appreciate it. Any questions?
You speak for all millennials there, John?
Yes, I do.
Poster child. Good.
I'm the poster child.
Yeah.
So real quickly, if I could, Caitlin, already has appointments for the next 3 meetings on your calendar. Obviously, we're going to set up something else based on Michelle's feedback and you guys' feedback to review the country exposure and so on. But because we're doing this via WebEx, we also have to have IT send out their own invite with your own email on it. And that's creating duplication on your calendar. So right after this meeting, Caitlin is going to delete what we have put on your calendar for the remainder of the year. And we made the appointment that IT sent out kind of generic. So it assumes that if we meet WebEx, it'll be available. And if we sometime later this year are not meeting WebEx, it still is applicable. So please don't get confused after this meeting. If you see 3 cancellations, we're only canceling the duplication. And thank you for doing that, Caitlin.
Fadi and your whole team,
Welcome.
Thank you so much. Caitlin, thank you.
And Caitlin,
You're
Tom
welcome.
Curtis here. Could you make sure you send one both to my business and to my personal Gmail?
SunTrust and Gmail.
Yes, thank you.
Sure will.
Thank you, everybody. Keith,
Thank you.
Dan,
Thanks, Christine.
appreciate it. You guys take
Thank you
care.
all.
Thank you.
Bye-bye.
Thank you. Bye-bye.